Hello, everyone. Thank you for joining us for another episode of Tilton. I'm Haley Lacey, head of social media, and here we have Mr. Tilton himself, CEO Aaron Tilton. Welcome back, everybody.
Hey, thanks. You're in Dubai, right? You're out in the other side of the world right now.
I know, I can't believe it. I'm just saying it might have Utah crypto climbing in and technology advancements. So I want to share with anybody with some big news, or we're keeping it on the hush hush. What happened last weekend, Aaron?
Oh, you're cutting out just a little bit. Can you say that again?
Do you want to share with the community what happened last weekend?
Well, I got married. That happened last weekend, so that was amazing. It was awesome.
So do you feel like a new man?
Something like that, I would guess. You know, and I don't usually put a lot of my personal stuff out there in the crypto sphere, but Carrie's an amazing person. And certainly it was a life-changing event for me. So I'm extremely excited.
We're really happy for you and the whole community. So that's awesome. Congratulations again, Brianne. Just amazing.
Yeah, thank you. We're having a little problem, hey, with your audio, it seems like, because you're cutting out a little bit. So we might have to have Costa start asking the questions there, maybe.
Yeah, maybe you want to reconnect
Awesome. So
Haley
Costas, let's
in
get
the
it right
meantime.
into it.
Yeah.
Awesome. Sounds
Okay.
good. Well, thank you, guys.
Okay, so basically, Aaron, I was wondering if you can tell us a little bit about how you can earn interest on crypto. What does the process entail? How do you go about basically investing some of your crypto funds into an interest account?
Yeah, so for the Smart Interest account, one, it's available in the United States for accredited investors. Two, or outside of the United States, right? If you live outside the United States or you're an accredited investor. So that's the first thing you have to do is see where you are and do you really qualify. If you're in the United States and you're not an accredited investor, and most people know if they are not, because they're in the space and they're doing it more of a high net worth client. So those are the first two things. So you can deposit crypto into those accounts. You cannot deposit dollars. We don't do interest rates on dollars. It has to be crypto, Bitcoin, Ethereum, or stable coins, but you can deposit that into the account and then you earn a daily rate on that. And those funds basically go to make loans with the loans that we have in either the real estate or crypto structures that we have with customers who are borrowing against using the platform and kind of matching up with what we're doing.
Okay, fantastic. And I mean, a lot of people are asking, how can companies like SmartFi and others, how can they offer interest on crypto? And is there any types of risk involved in doing that? The question keeps coming up on Twitter.
Yeah, first off, there's risk in everything, right? It doesn't matter what you're going to do. If somebody tells you there's no risk in this thing, you should run, right? That is not realistic. That's not what happens. There's no such thing as risk-free structures because there's a lot of risk in things that that are unforeseen, or all of those issues that other people who may be offering a product don't realize. For example, the Terra Luna debacle that took place, they thought they had an algorithm that would keep the coin stable and pegged and everything would be all great. And it collapsed within 24 hours or 48 hours or whatever it was. So that's the first thing, is make sure that you understand what you're engaging in. Two, the structures of what's being lent against. In our case, right, we do small business loans, cryptocurrencies, and real estate. And so we take those proceeds from either buying SMTF tokens or depositing into the SMTF, or I'm sorry, the smart interest accounts. And we make loans to other people. And then we try to collateralize those loans with more than what is necessary to hold that transaction harmless, or if that loan was to go bad, then we would have enough collateral to be held, to be capitalized essentially. So that's kind of
Okay.
the risk, is if loans go bad, then the liquidity could struggle, or we'd have to go back and repossess that stuff. But that's the risk that's associated with what we're doing.
But it's not magic, right? It's like mathematics. So we can lend to people at a higher rate and we can offer a lower rate on interest.
Yeah, and again, it's subject to all kinds of the conditions in the market. Last year, with the broader economy, you saw a lot of defaults with crypto, but the other assets like real estate and equipment that was used in small business loans actually performed really well for us. So you have to be diversified. You have to build a structure that really has cash flow associated with it, right? It has value.
You touched a little bit upon who qualifies for a crypto interest account. You covered that in the States, you have to be a qualified investor, but that doesn't affect any other areas of the world, does it?
Now, if you're outside the United States, then you can participate without being an accredited investor.
Okay, fantastic. And can we explain to people a little bit, because there's a lot of people new to crypto, what compounding is? What is this concept based on?
Basically means whatever interest you would earn daily. So if that was compounding daily, that interest would be earned and then go on to essentially the component that actually generates more interest, right? So you're getting interest and it's accruing daily, and then we pay it out weekly. So at
So
the end of the
basically,
week,
the interest is paid out in your account, and next time your interest is being calculated, it compounds basically on top of whatever you had in your total balance. You get the extra bit of the interest. Am I
yeah,
am I
exactly.
getting this correctly?
You're earning a
Yeah.
return on that interest that was paid to you early on.
Yeah. Okay. Fantastic.
Yep.
And I mean, you touched upon this a little bit again as well, but how do we define crypto interest rates? Like, how do we pick the rates? You said it was based on market conditions. Is there any other elements that we add in there?
Yeah, there's liquidity, there's cost of capital. When we tend to form hedges or structure things using crypto that provide liquidity in dollar denominated terms. So with cryptocurrencies, there's an additional steps that we take to go through to convert that to make the funds available to other people in dollar terms. So there's a cost to that. So that determines what the interest rate is that's paid out in cryptocurrencies, right? Because then we'll have to go back and convert that back and forth. So there's the stable coins are easier to pay out on because they're already dollar denominated, basically, or they're stable in the dollar terms. So they're less expensive to use and simpler. Cryptocurrencies are more expensive to
Mhm.
use because you have to convert those to structures or form a hedge, and that has a cost to it.
Yeah, that makes total sense. Yes. Okay. So, is there any implication on tax? So, when you earn interest on a crypto account, does that fall more or less roughly under the same regulations that any other sort of activity like that would fall? Because we know that when we earn, bank interest, you have to report that.
Yeah, it's exactly the same thing. Even in crypto, whether it's stable coins or Bitcoin or Ethereum, as you're earning that, whatever day you earn that, they take into consideration the price of the crypto on that day, the average price, and that has to be reported to the IRS if you're a U.S. citizen under a 1099 structure that says, hey, this day or this week or whenever it was that you accrued it, this amount of interest was earned on this price basis.
Okay, that makes total sense. Yeah.
Yep.
Um, we have been to jump a little bit now into more the area of SMTF and SmartFi and what SmartFi is doing. We have been experiencing a prolonged bear market for a while now, and I mean we've seen just Bitcoin jump up again to nearly 25K in the last couple of days. But what changes is SmartFi making to adapt to this new market situation?
Well, when we talked about liquidity earlier on in terms of redemptions for SMTF or liquidity for smart interest accounts, the going to a more stable asset like real estate or equipment loans, that cash flow, they're predictable, they don't have the same volatility, but they are less liquid in terms of certain structures. That's not always the case, because in some cases, Bitcoin or Ethereum or other cryptocurrencies, if they're smaller cap cryptocurrencies, they become highly illiquid, right? And those assets become stranded based on market conditions. For example, at the end of last year, when FTX announced that they were going bankrupt and they were basically suspending all their transactions, Bitcoin and liquidity for loans became almost non-existent. There were no counterparties trading Bitcoin at that time for loans because the counterparty risk was completely opaque. Nobody had visibility to who had risk, right?
Yeah.
So nobody was trading with anybody. So at that point, those structures were highly illiquid. Even though Bitcoin, you could buy it or sell it, nobody understood who was holding on to what cryptocurrencies as collateral for loans that was impaired. So with a real estate deal or with small equipment loans, they can have periods of less liquidity, but they always kind of tend to be less liquid because you would have to conduct a sale that is not on an exchange, like with land, or you'd have to go find the equipment that somebody was using to sell it or to basically take possession of it. So it's just different types of risk that you have, but diversifying that risk and the sector of the economy that you're lending in has a much more stabilizing effect, and other banks and other financial institutions who have more of a generalist approach like a bank, they try to diversify their exposure to certain environments in the economy.
Okay, so in terms of SmartFi and SMTF, can we expect some changes that relate to interest accounts? Is there a connection there?
Well, let's say for a buyback guarantee, you could take your SMTF, convert it after a year, and then maybe convert that to a coin interest account, a smart interest account, and start earning interest on it if you were an accredited investor or outside of the US. And that has some optionality to it. For example, when the market is cratering, like last year, Bitcoin was way up, now it's way down comparatively.
Yeah.
You didn't have that same volatility with SMTF on a redemption basis. Your basis, whatever you bought it for, you're going to be able to redeem it for. Then you could convert it. So you didn't necessarily have those losses, but you didn't have any gains either. But most assets last year lost, right? There was nothing really that was gaining. There may have been some other assets around that, may have had some gains, but for the most part, SMTF is about being safe first and then speculating. And so it has some optionality to it because it's backed with the assets of our loans. Or that's how we basically have the ability to redeem it. Although in cases where the markets are constrained for liquidity, they can become somewhat illiquid, and then we have to basically do pro rata redemptions. So we have been implementing that over the last month or so for SMTF and smart interest accounts. It's just safer for us, safer for the clients, and going forward, it's a more equitable solution for liquidity as people say, well, I want to get out of this asset and maybe transfer to this one instead of drawing down all the liquidity at once. It's over time.
Okay, so you hinted there that there might be some changes in how the buyback guarantee operates for the token.
Yeah, no, it's already been announced, and we published that last week. And when the other podcast that we did, not last week, but 2 weeks ago, we announced that there were some changes. All of that has been published. You can go to the terms of use on the website and go to some explainer pages and the FAQs and learn all about what the changes were, what we did. It does two things for us. One, it allows us to stabilize liquidity and actually grow and expand to some of these other fields or these other sectors of the economy, like real estate, and get bigger, look at some other structures and actually do more lending. That was one of the biggest reasons for the change, is we can expand as a company on a more stable platform.
And can we talk a little bit to the community and to everybody who's listening on how does the safety first approach work in this environment and what that means for SMTF? Again, you touched quite a bit on some things, but I was wondering if we can talk a little bit more in detail about the collateralized loans, the real estate loans, the equipment loans, and all these different structures we have in place to make sure that we are not just different but also safer.
Yeah, I mean, just as we mentioned before, having real world assets, something in the real world that has been, the proceeds from SMTF or from smart interest accounts have been used, those proceeds, to fund those loans. It's not like Terra Luna Vapor stablecoins, right? Or other things that can be just evaporated overnight. In the loans that we've done, probably 80%, maybe almost closer to 90% now of our portfolio is in real estates and hard assets. So overnight, it doesn't disappear. Land doesn't disappear. Real estate doesn't disappear. But if you're in a DeFi protocol and something happens to uncouple the algorithm or the protocol, it's gone, right? And trading tends to be zero-sum transactions where one party wins and the other party loses. And we were not comfortable with the DeFi structures. We didn't participate in the DeFi structures at large. We had a few that we tested, and what we basically came to the conclusion is there was too much risk for what we were looking for in longevity. But we were not giving 19 or 20% returns like other protocols, but those returns only lasted a very short time, and people realized that was not real, and they went bankrupt, right? Or they disappeared. So in reality, they were just basically trying to attract people with higher returns that were really not real in the first place. So our returns are measurable. They're reasonable. They're not these crazy numbers. And we're still around doing loans and paying interest on our structures when everybody else or these other people that were doing these high risk or higher risk structures are gone.
I actually remember a bunch of us coming to you like last year when we were looking at the interest rates and we were trying to compete with other companies in the sector. And by far, we didn't have the highest ones. And when we were asking you about it, you were just saying it's simply unfeasible. It's just, it doesn't work. And obviously, we weren't happy because we wanted to push more and, get higher rates and get more people on board on the platform. But what does that say about stability?
Yeah, and you have to have some integrity as well, right? You've got to, even when everybody else is doing certain things that they're somehow, I would say they're not really winning, but they're achieving their objective in the short term by doing things that are what we would consider, some were borderline criminal, right? In some cases, they were criminal, like Celsius or these other groups. And I guess I should say allegedly, right? They've got to go through the process to go through that, or FTX. And we knew what was going on in terms of how the market works. And I could, look at what they were doing and what they were offering. I said, it's not real. It's not possible. And, other people thought, well, they're different, or they're the new wonderkins of the, FTX was becoming very visible and they had a lot of money on marketing. And I just said, that's not real. That's all going to end badly. So we were careful to stay clear of exposure to those groups and just watched we knew would unfold as something bad was going to happen. And that's basically what happened.
A lot of people in the community right now are asking about, the terms and about the buyback guarantee. I mean, this is a scheme like the buyback guarantee, which is meant to have changes to its terms over time. Isn't that the case for most of these types of schemes?
Yeah, and if you look at the white paper, in the U.S., we would say, model. In the U.K., you guys talk about it in terms of a scheme. In the U.S., that has a negative. So
sorry, I meant program. Sorry. Yeah.
There you go, or the model.
Yeah.
But in the white paper, all along, we knew that we were going to adjust. We were going to start lending in the real world. Initially, we did a lot of our lending in the crypto space, which, for the last 5 years has been reasonably good. It's had its ups and downs, and we wanted something with more stability. But all along, we had planned to make these changes, these structures, and move forward and show how the stability or the underpinning of the assets work to keep things safe, regardless of what the price of SMTF going up or going down in the secondary market. The buyback guarantee is designed to provide a baseline or stability, so that when everything else in the market is kind of cratering and collapsing in crypto terms, the real world in terms of real estate or these other assets tend to be more stable. So all along, that's part of the plan. It was in the white paper from the beginning.
Yeah, that's I think that's important to highlight to everybody for sure.
Yep.
Okay. Do we have anything else that we forgot to leave out in regards to the changes? Are we having any further changes with the SmartFi products? Is this going to affect loans? Is it going to affect the SmartFi token in any other shape or form?
The loan, all other products are the same, right? The exchange, the swap, the loans, those haven't changed. It is the SMTF tokens, that structure, and the smart interest accounts for liquidity to manage that process so that it's balanced, right? In the white paper, we often talk about the concept of balance. And that always has to take place, where you've got to balance your liquidity with your lending and with the capital structures so that they stay in balance and don't go inverted one way or the other. So that's in keeping with this concept of what initially was there. So when people either bought SMTF and to read the white paper and those structures, sometimes the white paper being long and a little complicated, to understand the economic terms, but this is a real world experience where you've always got to anticipate things where the markets go down or when they go up. And in the cases where they go down, that's the toughest. When things are going up, everything's great and fantastic, right?
Yeah.
And we also took the position that when things were going up and crazy things were happening, we took the position that that's technically not real, right? It's when prices go up and you're holding an asset, unless you sell it, you haven't realized the gain, right? In terms of trading or financial institution, that's called an unrealized gain. It's only paper value, right? So that's important for people to understand, especially in crypto, that if you don't have realized gains, you cannot lever those assets. You can't go out and initiate real world transactions on unrealized value, right? Because it just as easy as it goes up, it can go down, and we've seen that. So having stable assets, having real world assets that don't have the crazy fluctuations up either, but they don't have the crazy fluctuations down, right? And that's an important concept. And for a lot of younger people who are getting into a financial transaction, or they're looking at doing something with either some money or crypto that they have, it's super important. It's an important lesson to learn, to not get too exuberant and to realize that there's risk. There's always risk. And to understand what you're engaging in, what community you're in, and what the ideology behind the community you are. And for us, it was always safety first, right?
And it's important to highlight as well that we're still honoring the 60-day buyback guarantee, and that system is all in place.
One of the
and
modifications there, though, you would pick up on is that you don't have to wait 60 days anymore for the audited structure. We looked at that, thought that was a little bit long. We were able to complete it in some cases longer. But what we did need to do is we created a new wallet space, which was called BBB, which is a wallet balance. So that's the buyback balance. So it gets converted to a dollar basis. So then you don't have the SMTF tokens. We pull those back in, but now you get a new wallet balance. And then you apply for the pro rata share of that liquidity every 30 days. So the waiting for the buyback is a little bit shorter in terms of qualifying. It's a two-step process to making sure that we sometimes have people who have bought tokens go out, trade it, do a bunch of different things with it, and then try to bring them back to us and say, oh, I want the buyback guarantee. And we say, no, we don't engage in buybacks on tokens that we can't authenticate that were held in basically a hedge structure, right? So that's why we do that. But we were able to kind of start doing that a little more efficiently. And then when you have a buyback balance, you can apply that to the liquidity and say, hey, I would like X amount to be converted to a dollar balance. And then every 30 days, you get a pro rata share of what's available in the loans that are maturing. We may make more loans or less loans depending on what's happening or the cash flow that comes in. So that's the structure that's important to understand.
Fantastic. Well, I know we can go on forever, but there is one last question I wanted to ask you. And this question is something that I think we've answered in the past, but people keep asking. And I know that from what I've heard within the company, we have been doing something in that sort of side of the business. People are asking, can they earn interest with SMTF? And does SmartFi have any plans to offer this?
We won't, because if we issue a security and then pay an interest on it, or not, I guess not a security, but we issue a token and then pay interest on it, it becomes a security, which the token is not, right? So SMTF, we specifically state you can only get back from us the original purchase price. If we started paying interest on it, it'd be considered a security. So what you have to do is when you buy the token, you can either sell it in the marketplace, you can hold it, or you can convert it with the buyback guarantee. And when you convert it with the buyback guarantee to maybe a stable coin like Tether or Circle, then you could deposit it into the smart interest account and earn interest on it. Okay. And while the prices are low for a lot of assets, it's a good time to buy, buy an SMTF and then wait for the price to do what it's going to do in the secondary market. That's another opportunity using your own ability to trade, on ProBet or these other exchanges that it's on.
Absolutely. Okay, fantastic. Well, thank you very much for all this time, and apologies that Haley had some issues with her audio and couldn't be more part of this today's episode. But we're going to be back on the 2nd of March, and we're going to have a lot more interesting things to talk about then. So yeah, thank you everybody for coming on today. You've been fantastic, and with all your questions and your participation. Don't forget to like and subscribe to our channels, because that helps. And please come back, because we're going to have a lot more interesting things to talk about on the 2nd of March at Tilton Talks Crypto.
Thanks everybody.
Thank you very much.
Awesome. Thank you guys. Goodbye.
Bye-bye.